Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. What did I tell you guys on Monday? We went over a hawkish and dovish scenario, but I told you the Fed was likely to remain hawkish because inflation is not cooling off and because previous Fed official comments show that they perceive the economy to be strong enough to withstand more hikes. Still, the market rallied up. People were certain that a 75 basis point is for some odd reason already priced in the stock market. As soon as the data came out, stocks rallied like the 4th of July. I began to see Twitter checkmarks saying "I told you so," "Get ready for the bounce," "SPY will go over 400 again now, from here on out get ready to buy." The slip-form reality was disgustingly palpable throughout social media. But still I remained unconvinced. You see, there was something that the Fed released that most people misinterpreted. In a statement, they said in fancier words that clearly market participants are too stupid to recognize that they will remain persistent about rate hikes and that they see room for even higher ones, albeit the increments will be smaller so as to not create panic. Again, it goes back to what we have been saying for a while. The Fed has to guide things in a very careful approach, not putting too much pressure whereas everyone just throws their hands up and gives up, starting the beginning of a massive sell-off that will for sure crumble what little is standing on this dilapidated economy. But the Fed also has to push strong back against inflation with severe stubbornness because letting inflation sit too high too long will inevitably cause markets to fall. There is a fine line that the Fed needs to balance, and I think they figured that the economy is strong enough to withstand more rate hikes but too fragile for them to remain around 25 points in increment, so we could see a smaller increases in basis points at future meetings. For some reason, the market completely ignored this statement when it came out, with people rallying hard and calling us, the more sophisticated bear participants, out of touch and overly pessimistic about everything. Well, that only lasted for a few minutes, because the man, the myth and the legend, Jerome Powell, came to the podium to say the things that bulls feared the most. Some of the statements said that the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. When on the podium, Jerome Powell rapidly began to share with us the main train of thought the Fed has by quickly dismissing the idea that the Fed will be pausing soon. Though he said that he expects a discussion, emphasis on discussion, at the next meeting or two about slowing the pace of tightening, he reiterated that it may take resolve and patience to get inflation down. He quickly reverted to a more sinister take on the economy, expressing serious pessimism about its future. He noted that he expects the terminal rate, which is the point when the Fed stops raising rates, to be higher than it was at the September meeting. Then, without a modicum of lube, Jerome Powell hammered out whatever hope any bulls had with the following sentence, and I quote, "We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected." If you look back on the minute SPY chart, you see that long big fat red candle? That was the immediate responses that crippled any bull's pipe dream for good times in the market. With higher rates comes the prospect that the Fed will not be able to achieve the soft landing they have spoken in the past. Powell said the path has narrowed to a place where the economy doesn't enter a pronounced contraction. He later on reiterated the need for policy to be more restrictive, narrowing the path to a soft landing. The Federal Open Market Committee categorized growth in spending and production as modest and noted that job gains have been robust in recent months while inflation is elevated. Powell did mention he sees a path to a soft landing where there are no severe contractions, but the current economy in the US has shown virtually no growth even as the full impact from the rate hikes has yet to kick in. All in all, Jerome Powell pretty much reiterated some of the same exact points we made on Monday and in previous videos where we reviewed the economic output of the US, so the question still remains, why are some analysts and politicians hyping up a dovish Fed? It is very simple, it has all to do with election season. Let me reiterate the strategy from the government once again. Their job is to soothe out any panic because their sole duty is to remain in control of things. Panic and chaos always equate to a brutal market crash and economic depression. We cannot have that, so the government will instead work 24/7 to tell people to remain calm, that they have things in control, that it isn't all too grim, because they understand that the economy is slowly falling, but they just can't handle a crash. Instead, a sophisticated and paced drop over time is much more attractive. We fall steadily and there are not that many issues with the masses so long as you keep general supply chains up and running. Tell people we are in a pretty bad recession, get ready for uncharted and uncertain territory in terms of money, and you will see economic spending across the entire globe come to a halt faster than the SEC halts GameStop when it starts to run. And with these news comes the most important question of all: what now? Well, it's hard to tell, and I don't like making any specific claims as to how the entire economy will pan out because it's deeply irresponsible. However, I can give you a general idea of what you can more or less expect to see. First, you will see high volatility in the markets, and I mean every market in the world. The Fed is hawkish, but many investors, whether by their own opinions or heavily influenced by that of the government and Wall Street, are dovish. This could see indexes like S&P 500, the Dow and Nasdaq have strong upward movements. However, uncertainty is something that even the biggest bulls in the market cannot shake off. There is not a single piece of evidence that shows the United States has made any modicum of progress in battling inflation, and until we see that, any bullish sentiment is born out of stubborn arrogance and not objective optimism. As such, I expect markets to have strong bull rallies on any news with bulls yelling "I told you so," but long periods of general stagnation in the market where we see a downtrend. People want the economy to improve, for things to go back as they were, and the markets will display the effects of this psychology taking place, but reality will always come around the corner and knock this digression down on its knees. To put it simply, when it comes to rate hikes in the future, do not get it twisted. There is little to no expectation at all that they will stop soon. My takeaway from Jerome Powell speaking is that he will be talking dovish in the future with attempts to appease investors from scaring off into a panic-selling frenzy, but hikes will remain high for the future, at least into summer of next year, as I have been predicting all this year. There is a good chance we could see a slower pace in them, however, depending on how things shape out. When diagnosing the future of the markets, now that earnings are out and the Fed spoke, the one remaining variable are CPI results. If in the next couple of months CPI numbers don't start coming down, I see the Fed raising interests, perhaps not by 25 points, but they will raise them with no question. Jerome Powell was very clear in his stance about fighting inflation and not venturing off into giving in to short-term demands by childlike investors who need their portfolios to go up. We need to see not only good CPI results, but have them progressively better in each month, so that there is a track record of improvement that can give the Fed an objective confidence to begin easing off on inflation. Now that all the main things Fed have been said, we need to talk about the economy. I didn't make videos during the earnings last week, but let me tell you, they were absolutely atrocious. The fact that Apple is the only company that made it out relatively well shows the pains the tech sector is about to begin enduring. A lot of people want to price in stocks when we haven't come close to seeing the fallout that is about to occur before our eyes. Here's the gist of it, people. Tech firms are bracing for some serious tough times in the coming months. They are tapping the brakes on hiring as they contend with decreased consumer spending, higher interest rates, and the impact of a strong dollar overseas. Amazon, the e-commerce god, halted new incremental hiring across its corporate workforce. Digital banking startup Chime announced they are cutting 12% of their staff. Galaxy Digital said they are considering eliminating as much as 20% of its workforce. Lyft is planning to divest its vehicle service business. They announced they would freeze hiring in the US until next year and said they are not immune to the realities of inflation and a slowing economy. They are already talking about how in 2023 they need to better execute without changes on these plans, which speaks tons of how their upcoming earnings are going to be. I am thinking of loading in on puts. Stripe, one of the world's most valuable startups, is cutting more than 1,000 jobs, a 14% staff reduction, and Twitter is cutting as much as 3,700 jobs. As you guys can see, the bleeding is about to get real serious with big tech, so it honestly shocks me to watch people say stocks are going to be bouncing up real high when the fundamentals are all screaming run to the hills and hide your money in your mattress. When I look at the stock market, I see the pronounced gains that tech companies brow in. Now that they are bleeding heavy with bearish news almost every day, I watch bounces on SPY and it begs me to question what in world is causing some people to press buy. Regardless, my stance on stocks is to continue to wait until next year before loading up on long-term investments. This market is clearly as bearish as it can be, and there are no signs of life in it for the moment. GameStop and AMC continue to follow the general market, though I have to point out how well they continue to hold up. I will continue to load up on my shares at a careful pace so as to not get too greedy while they could come down lower and miss that chance for a higher purchase. That is all I had for you guys today. Come say hello on the Discord, and I hope you all have a great rest of your day. Hope to see you on the next one, to the moon.